right, well, lockdown presents many opportunities. Obviously, we're a little bit sick of making sourdough, and for some of us, finances are now top of the list of things to be sorting. We know that of everyone experiencing this economic uncertainty, you kind of fit into three categories. You've got those who are truly sinking, their income has been impacted and they need tactical actions that they can put in place, and they need to understand the sequence of those actions. I'm going to give you some tips on that tonight. We've got those who are in a floating position, so not really sinking, just not getting ahead particularly fast. And this is another wake-up call for you to master your money and start making progress. And then we've got those who are in a position, they are ready to grow wealth, they're ready to maximize where they're at. Now, we've got different webinars for those people. Tonight, we're going to talk about those who are in the sinking to floating category and those who need tactical changes to get in control of their money and ride through what feels like a storm. When it comes to financial success, there are two things you need to master. The first one is in the good times, you make the progress that you should. And in the bad times, that you course correct quickly, you make adjustments to reflect the new circumstance, and you hold your line. Easy to say, hard to do. So we've got quite a bit we want to jump through before we take some questions. So we're going to talk to you about those who are sinking, the current situation, how we Marie Kondo your finances, determining whether you're paying a lazy tax or fritter, things you need to be thinking about with mortgages, which I think that's scaring a lot of people, even if they're not sinking. We know that interest rates are about to increase. If you are struggling to get ahead now, then you are going to be sinking very soon. So now's a time to get your house in order and get things tidied up. Okay, so when you're sinking or reacting to an unplanned event, you need to be doing things. I guess we need to take stock of where we're at and understand what are the cards we've got to play and what is the order that we should be playing those cards. So I guess the definition of sinking means there is not enough income coming in to cover your outgoings. Now, that could be because you're self-employed and your business hasn't got any income coming in or insufficient income for you to take the drawings out that you need to fund your household. It could be that you are in between jobs. It could be that you've taken a pay cut as a result of lockdown. But if your personal situation is such that there is insufficient income coming in to cover things, to carry things going out, we've got to address that. And depending on, I guess, the degree of your commitments, we've got different things that we could be doing. So I think if we go here, that for those who are truly sinking, so there's not enough income coming in and you have a mortgage, the most common question we seem to get is, should we go on a mortgage holiday? And the answer is perhaps, but you need to have exhausted all other options first. So if you're sinking, you need to compress your outgoings, so reduce your expenses. One of the best things about lockdown is that you just can't spend money. So we know that typically people are able to save at least 15% of their income because they're not able to spend that in other areas. So that's an advantage to you. But when you're in a lockdown, or if you're truly sinking, you need to cut things right back to the bare bones, which means you cover your accommodation costs, which is either rent or mortgage, and we try and get that as low as possible. You have sufficient funds so that you can eat and cover your utilities. You keep your insurance payments up. And there might be a little bit of discretionary income, but really you're not traveling anywhere, that you can't spend excess amounts. So that means that it should be the easiest time of your life to save money. But if even saving money, you are struggling to meet your commitments on your debts, whether that's short-term debts, whether it's your mortgage, then we need to go through things in this order. If it's a mortgage, if you're wanting to reduce your repayments, you first try and lengthen your mortgage term. So that what that does is it reduces your mortgage payments, but you're still paying off the principal, which is a good thing. If that's still going to be too high as a repayment, you then opt for interest only. If that repayment is too high, we then apply for a mortgage repayment holiday. Now, a mortgage repayment holiday is not something, well, it's certainly not a holiday. The payments you should have been making to the mortgage are accruing, so they are growing, and you're getting interest charged on top of those. So it's kind of like a double whammy. The analogy that I once used to describe that was, it's like you're in a taxi and the meter's going up, but you're going nowhere. So that's not a good feeling, and it's something that you do if you have to, but you do it. It's the last line of defense when it comes to your mortgage. For those who are in KiwiSaver, you would go on a KiwiSaver holiday, or if you're self-employed, you'd reduce your contributions to $1,040 per year. If your employer is contributing to your KiwiSaver, you might be asking for them to pay that, what was going into that KiwiSaver fund, to you directly. That's not going to be appropriate for big organizations, but for smaller organizations, there might be a little bit of flex there where the employer is still happy to pay that money because it's of no consequence to them whether it goes into your KiwiSaver or into your bank account. This might be a time where you're asking to cash in some holiday pay. If you've got a credit card balance, you'd be looking to do a credit card transfer where you're transferring the balance to another credit card. That might give you a lower interest rate for a 6 or a 12-month period, which gives you some room to make up some ground. This is a time where you go through your assets, and anything you're not using, whatever toy it is, you sell. It doesn't even matter if you sell it at a loss. It is about getting income in to replenish the coffers, to buy you runway to stabilize. And the problem with sinking is that often the rational thought goes out the window. I guess the extreme of sinking is that you would need to sell bigger assets, whether that's cars or even property. But hopefully we've created enough runway for that not to be a fire sale of either of those assets. So lockdown, you might get locked down, but this is when we get back up again, right? So what it highlights is that you can cut back on your spending if you need to. We know that on average, we spend around 15 to 18% of our income on discretionary costs. So when we can't spend that money, then that is money that can be saved. So most families have a tolerance of their income dropping by at least 15% because they can make immediate cutbacks to neutralize the impact of that. But that's I guess, a holding pattern. What we try and do with our clients who don't tend to be sinking, they are more trying to stabilize, to maximize their capacity and their capability, as we look to Marie Kondo their money, where we're trying to get things organized. We're trying to identify, what do you spend money on that brings you joy? We want that to be part of the plan going forward, but if it doesn't bring you joy, then it could quite possibly be a fritter. And we know that on average, we fritter 15% of our income. So if you're thinking about that, we've got 15% of our income is going on discretionary spending, and another 15% is potentially getting frittered or wasted or unconscious spending. If we can capture those two things, well, that's when we start to move ahead quite quickly. So lockdown is an opportunity to replenish your savings, to create your buffer, to improve your financial resilience. What does financial resilience mean? Well, we want to make sure that you could survive with a drop in income for 3 to 6 months. If we know we've got that, then that's when we would say that your financial flank is protected, and we can then lean in more purposefully towards creating wealth, which is certainly a lot more fun. Now, what we know is that 90% of Kiwis are paying lazy tax or are wasting their money in different areas. So they're either paying more than what they need to on their utilities, their broadband, their contents insurance, sometimes even petrol. But 90% of us are just wasting through just slightly inefficient spending. And if I was to describe most of our clients, I would probably say that they are comfortably inefficient when they first start working with us. So we want to try and work out, well, where is the fritter going? Where is that money, and how can we start to bring that in? Some of it is through an example here. So your utilities or your fixed costs being higher than what they need to, and we're not shopping around for discounts. The other area where we tend to fritter money is on how we structure the mortgages. Most mortgages are structured to pay the most amount of money back to the bank over the life of the mortgage, not the least. And I'm pretty sure that paying more to the bank doesn't bring you joy. So by default, that would be a fritter. The other area where we tend to fritter is on food, where we spend a little bit more than what we think we do, more frequently than we realize. And then the fourth area where we fritter is on your non-negotiable costs. Of those costs that do bring you joy, what is the sensitivity over that spending? Does the joy keep increasing as you spend more, or are you actually getting a diminishing return for the more that you spend on these costs that would be really important to you? That's when we get into the sensitivity of your spending. But the first thing is, let's just find the lazy tax or the lazy money. When we're looking at ways to make some quick savings, quick bang for your buck, you would be reviewing your power provider. Switching it is fairly easy. You check out your mobile, your broadband plans, check out your insurance premiums, get rid of TV subscriptions you don't use, review short-term debt, interest rates, repayments, late repayment fees. These are just such easy wins, but we give so much money away just on these things. And if you can't get a pay rise, and I was talking to a client earlier today and coaching them on how they negotiate for a pay rise, but for some industries that's not possible, and it could almost be bad taste to ask. But if you can't get the pay rise, that means you find the fritter, because if 15% of your income is getting frittered, wasted, that's the equivalent of a 25% pay rise before tax. That's the easiest windfall that we can find. We know that 63% of us use credit cards, and despite the best of intentions, don't repay the credit cards in full every month, even though there might be the ability to do so. That's lazy tax. But the biggest areas of fritter, as I said, are how we've restructured, how your mortgage is structured. So that normally is a quick win. And then the next area is where are you frittering money? And it tends to be in food. We spend more on groceries, takeaways, normally work lunches and coffees, and cafes and restaurants. When we add all those things together, it's more than what we realize. And on average, we try and cut that back by about 30% for our clients, as an example. Now, obviously in lockdown, we're stretching out what we spend on food. If you're like me, your food bill's gone right up. But I think what was getting spent on cafes and work lunches and coffees is actually just getting added to the grocery bill. When we did a bit of analysis on this on different families, the way that they spend their money on food changes in lockdown, but that if we add everything together, it's still a similar amount going out. So, if we want to catch fritter, we want to focus on that. Now let's have a talk about interest rates, because people who were floating or bobbing up and down when it came to financial progress, if interest rates are going to increase, then that might move them from bobbing to actually being under the waterline. So when it comes to structuring your mortgage, it isn't about just the interest rate. It is about the pace at which you are paying off your mortgage. The faster we can pay the mortgage off, the less interest you will have to pay. Now, when it comes to paying off the mortgage or structuring that mortgage, there is a way to structure it so that you can minimize the interest cost and maximize your flexibility. When I talk about flexibility, that is your ability to redraw on the money that has gone against the mortgage, so we can repurpose that towards growing wealth. We know, courtesy of the Reserve Bank, that interest rates are on the rise. In fact, over the next 2 years, we'd expect interest rates to increase by almost 2%. Now, I think 55% of people are on fixed interest rates. So at some point over the next year or two, you're going to be coming off into a higher interest rate environment. And that is a problem for many situations. The most effective way to de-risk that is to get a mortgage reduction strategy in place and to be executing on that plan. Because if we can reduce the amount of mortgage that you've got, the interest cost lowers with that. So even if the interest rate increases, it's against a smaller portion of debt, which is to your benefit or to lower your overall costs. We're expecting in the next couple of months that the rates will go up by 0.25%. But by this time next year, they'll be 1% higher. Now, we're all about making the most of your opportunity. So for some people, if you have got stable income, this could be a case of, well, let's just sharpen things up. Let's get this baseline financial resilience in place so that you could comfortably weather some changes if needed. So let's save more. Then let's pay your mortgage off faster. And in creating that equity in your property, then let's repurpose that to buy an investment property. The reason why we want to do that is if you've got a mortgage on your home, we don't want to compromise the pace at which you're paying that mortgage off. And an investment property allows us to grow wealth without diverting your cash in a different direction. So you can still keep that mortgage reduction strategy going. So you have a two-pronged approach. Now, if you've already got your investment properties and you've grown that portfolio, it's then time to diversify into other wealth options. Now, there's a bit of a science behind how we do that, but we're trying to grow enough wealth over the next 10 years so that you would be able to retire comfortably if that is the objective. On average, when we work with clients, we try and position them so they're creating $1 million more gain through working with us over a 10-year period than what they would naturally be on track to achieve. And that's taking a four-pronged approach. It's maximizing the cash surplus. If you don't have a cash surplus, we start there. Even if you've got a good cash surplus and you think that you're flying, we get you flying higher because your cash surplus is the engine room to how you get ahead. Once we've maximized that cash surplus, or concurrently, we then focus on paying off the mortgage faster. We then focus on reaccessing that equity and growing wealth off the back of that. And then the fourth piece is diversifying into other investments. So, about to take some questions, but just a little bit of housekeeping. For those who qualify for COVID subsidies, my recommendation is, so the resurgence support payment is $1,500 per business and $400 per employee, and the wage subsidy is $600 a week for a full-time employee. I think the resurgence payment can be claimed at different stages, whereas the wage subsidy, you have a two-week window to benefit or to claim that. And once you've missed that window, you can't reclaim. You're then available for the next window of the wage subsidy, and there could be potentially 3 separate windows. Now, for those who aren't sure if they qualify for the wage subsidy, the first window closes at 11:59 this evening. My recommendation would be to claim the wage subsidy, put it into a separate bank account while you calculate that, if you think it's probable that you would qualify for it. And if you don't qualify, then we would just repay that money back to the IRD. The reason for that is that some businesses, they're only doing their invoicing now for the month, and it's hard to get a read on whether there is a 7-day period where you might be 40% down in your income. So they're not on top of that on a week-to-week basis. And so if you think it's probable that you would qualify for it, I think it's safer to claim it, pay it back within 48 hours if you don't, rather than forfeit it if you are on the brink of sinking. So the subsidy deadlines: applications for the first instalment close tonight at 11:59. Applications for the second instalment open tomorrow. So the key takeaways: if you're sinking, there are some tactical moves that you need to make to stabilize your situation. It is all about stabilizing. Once you're stable, we then move into growing wealth, but you can't do anything if you're sinking or if there's volatility with your overall situation. Use lockdown to save more than you've ever saved before. Don't panic about rising interest rates, but use this as a window of opportunity to give you the nudge that you need to sharpen. We all need to be better when it comes to our financial progress. And remember that the opportunity arises at inappropriate times. So that's normally how you know that opportunity is that. It comes at the worst possible time. There is so much opportunity to be growing wealth at the moment, and the timing's annoying. But with this timing, there's also risk. So we need to understand, well, what are the risks? And in some situations, your situation is the biggest risk to you trying to grow wealth. So let's fix that first. Okay, so I'm going to take questions in a second. For those who want to grow wealth, who want a plan to be working towards and want to pull away from where we're at the moment, we are running a discounted consultation cost for those who have attended the webinar. It's $150 plus GST, normally $350. You just need to redeem that by this Sunday. Pop to our website, click on the button, request a consultation, and say that you heard about us through this webinar, and you will be receive that discount. You obviously don't need to have the meeting between now and Sunday. You just need to have redeemed the discount. Okay, so there are a lot of questions. So I'm going to hand over to Nadine and we'll get through as many as we can.
Thanks, Hannah. Kia ora, everybody. There are loads of questions. Some have come through in the registration forms and some are live. So let's try and get through as many of them as we can. I've tried to group some of them together because the topics overlap. So on money management, someone would like to know, is something like a Sharesies account a good idea for people like me who are terrible with their finances?
Probably not, but I guess if it's a small amount that we're talking about, no one really cares. I guess before you start to think about investing in different platforms or different types of assets, there's an assumption that you've got a buffer, a rainy day fund. And if you are actually just investing your rainy day fund, then you probably want to first stabilize before you channel some money into a different platform. If the amount that you're channeling in is less than $10,000, then we certainly wouldn't be too bothered by that. But if it's more than that, often you need to consider other investment options before you channel it into something which arguably is higher risk than what you've probably realized, which means that if you needed to access that money quickly, you could be experiencing volatility and you might not get back what you first thought you had put in.
How do you prevent spending unnecessarily when you feel you deserve to have certain things because you've been working really long hours? I think we can all relate to that one.
Yeah, I'm wondering if that's my subconscious self. Any financial plan has got to be rewarding you for the fact that you're making progress. I think that if you are naturally a shopper, of which I am one, we find it easier to spend money. That's half of our problem. And certainly if we feel a sense of entitlement because we have worked hard and we want a treat, that can be a real problem because it just prevents progress being made. I think the key is that we have to first create a plan so that the things that are important to you are recognized and you can do those guilt-free, but it's not at the expense of progress, because weirdly, when it becomes at the expense of progress, you will just spend more on silly things because there is this hopelessness that you're not going to get ahead, so you don't even bother trying. It's like if I'm on a diet and I open up a packet of chips and I have the first chip, and then I think, oh, I've had the first chip, I might as well have the whole packet. That's certainly my dieting philosophy. That's often people's cash management philosophy as well. So let's first give you hope. Let's show you what you are capable of, and let's show you what capacity we can unlock by improving your capability. And let's make it worth your while if you are going to make some sacrifices.
There are heaps of questions on property and mortgages, so I'm going to try and whiz through a few of those. The long and the short of it on property is, should we be investing in property given the new investor rules and not being able to claim interest deductibility?
Yeah, okay. So investing in property makes a lot of sense for most Kiwis simply because it allows you to use your equity, repurpose that to grow wealth. Not many Kiwis have cash funds that they could invest in something, which means that a lot of those other asset classes that you might normally consider or compare property against aren't even available as an option. So if you don't have $100,000 sitting in the bank account, we can't really invest in shares. Oh, you could invest with less, but if you don't have cash, so you can't invest unless you've got cash. Sorry, you can't invest. You can invest in the share market with cash. You can invest in term deposits with cash. You can do other things with cash. But if you don't have cash, you can't invest in a term deposit. You can't invest in managed funds or the share market. You're restricted by the equity in your property. So for many people, it is their only option. So the next question is it a good time to buy property? Well, it's always a good time to buy property if you've got the right property strategy. But the problem is that most Kiwis don't even have a property strategy. And that means that they are buying properties which it is unlikely they will be able to hold that property through a whole property cycle to get the money out the other side. So that means that I guess they are showing initiative on one hand, but not so much. They're not so clever that they have increased their probability of holding. And the thing with property is that the capital gain isn't consistent year on year. It tends to flatline before you get this almighty growth. And we all love the almighty growth, but before we get there, we also have to be able to get over higher interest rates and bank lending rules changing, which usually is when most people get burnt with property, which is just before we get the growth at the other side. So I think we've got to be really clear on what makes a good property for your particular situation. And not all properties are created equal. Not all regions have the same level of capital growth. Not all property types have the same level of capital growth. And not all property types have the same rent yield. We've got to understand those things and work backwards from what is this property trying to do for your situation. If it's trying to close a retirement gap, i.e. you're not on track to have enough, well, what is the size of that gap so we can make sure we are buying the right property to solve for the problem? So we want to, I guess, look a few layers deeper than what we previously have had to with property. With the new tax deductibility rules, you are looking to buy a new property because a new property is exempt from those tax deductibility rules. But we need it to have a good yield, to be in a good area, to be sure of the capital gain trajectory and to have confidence with that. And most importantly, to de-risk your own situation so that you could weather higher interest rates should that occur within the next 5 to 10 years. So if I rewind, I think that property is one of the only options most Kiwis can think about while they still have a mortgage, because you're paying down that mortgage and you've got to keep doing that. And so if you're wanting to grow wealth at the same time without compromising your pace of repayment, then property allows you to do that. Now, once we've got the growth on that property, we may look to sell it within 5 years, and then we might diversify into managed funds or shares or whatever the case is. But if your strategy is to grow wealth, in most instances, you need leverage to do that if you've got a short time frame. And the two areas where you can use leverage is with business, although it's pretty hard to do that at the moment, and with property. So let's first understand the problem to then work out what's the solution and then what's the detail for your situation. But is property a good idea? Yes, I would say it is if you want to grow your wealth.
There seem to be quite a few people who do have rental properties. One here saying we've paid off our home mortgage. Should our next goal to be to pay off the mortgage on our rental?
Not necessarily. I guess, again, there's an order of how we want to do that. So the question there is you've paid off your home mortgage. You've now got a really nice cash surplus. You've got money left over. Where do you put that money? Well, we could put that into another property. Whether we need to depends on whether we're on track for retirement or not. So I need to answer that question first. Then if we decide we don't want to invest in a property, do we want to bring in other asset classes to balance your personal balance sheet? Or if we don't want to do that, should we start to pay off the property mortgage? And if we do, what portion do we pay off first? If we have kind of gone through that and we've said, actually, we just want to pay off that mortgage, I would be paying off at the portion that allows us to unencumber the family home from that investment property. So that means that the home will always be standing alone and be outside of that property portfolio. That would be the portion of debt that I would look to pay off first. Then I would be reducing normally the debt levels to around 60% of the value of the property, which is normally enough debt or a lower enough balance of debt so that if interest rates increase, the property is still cash flow neutral. So if you are going to pay off debt, you pay it off to ensure that the property becomes cash flow neutral, so you don't have to top it up. Why do we do that? Well, if it's not requiring any cash top up, that means it's not creating any downward pressure on your own situation, which means your probability of being able to hold that property is almost indefinite, which is what we need. But then with that cash surplus, we want to make sure that the home is unencumbered as quickly as possible as well. So normally when we're working with clients, we have a property investment strategy. The overarching, your financial plan has got a cash flow plan, a mortgage reduction strategy, a property investment strategy, and normally a wealth strategy as well. And as some of those levers move, i.e. you pay your mortgage off, we then create a mortgage reduction strategy on the investment property, but that's always balanced against trying to grow wealth.
A follow-up question to that's come through live. At what stage would you say someone is ready to purchase their first investment property? So I'm assuming that's someone with a mortgage.
Right. So normally the biggest constraint to purchasing a property is what the bank are prepared to lend you for that property. So that would be the first question that I would be encouraging you to understand. And the issue is often between the banks, though, whether you go to your own bank or another bank, there could be 100 or sometimes a greater difference in what that lending would be. So when we're working with clients, we first go back to their current bank to see, well, what's the general pre-assessment that we could access staying with their current bank? And does that materially change if we considered a much wider base of banks? But we need to know how much would we get access to determine, is that even going to buy us a property? And unfortunately, with these new tax rules, we do really want you to be buying a new property, because even if you could buy a cheaper property, because it's existing, you won't be able to deduct the interest on that payments, which will make the holding costs untenably high, which means your probability of being able to hold it becomes a lot lower. So that would be a scenario where if what the bank are prepared to lend you, if that's not high enough, and we don't think that is going to increase significantly in the next year or two, we would consider other options to get you onto that property ladder if we need to use leverage. And that would include doing a joint venture with maybe a friend or a family member. But we've got to kind of work through all the layers to determine what's the best option for you.
Okay, a bunch of questions on mortgages. Everyone's worried about interest rates rising. Will the latest level 4 lockdown bring rates down again? We're about to fix. Should we fix it all or leave some floating?
Well, I'd probably say if you're about to fix, come and see us so we can tell you how to structure the mortgage properly. Look, interest rates are going to go up, and I don't think we're at full employment. Inflation is a problem and it's breathing down everyone's necks. The economy is relatively strong, and it's certainly strong enough to not be at these dire interest rates that it's in at the moment. The rates that we're on at the moment basically is assuming that the whole economy is about to fall off a cliff, and we are not in that position. So it's inappropriate to continue to have these high risk rates, which means they're low rates. So what should your strategy be? Well, the first thing we need to determine is, do you have a cash surplus? If you don't have a cash surplus, then you should be looking to fix for probably 1 to 2 years, because you probably couldn't afford to fix for longer. If you do have a cash surplus, we'd be wanting to break off a portion of that debt so you could pay that off with your cash surplus. And we'd then be working out, well, fixing a portion for 1 year, 2 year, and 3 year, most likely. Gone are the days where we'd be wanting to fix for 4 or 5 years, which we did like doing only a year or two back when the rates were really nice and low. The reason for that is that there is a disproportionate increase in these longer term rates, bringing the higher, your weighted rates to be higher than what it needs to be. So the strategy for some of our clients where we might have previously fixed for 5 years might now be, look, let's fix for 2 years or 3 years, with the view that we'll then fix for 1 year and 1 year, because a 3 year plus a 1 year rate in 3 years time and a 1 year rate in 4 years time, the weighted average impact of that is lower than what we expect the 5 year rate to be today. So we just want to work through those things. Now, obviously, if you're on track to be mortgage free faster, and we try and unlock that cadence for our clients, because that materially impacts how we would structure mortgages. But we would work through that. If you have, I guess if you've got investment property debt versus your home mortgage, so your priority should be to pay off your home mortgage, and you'd want to keep that investment property debt kind of sitting to one side for 2 to 3 to 4 years, ideally even interest only, so that all surplus can go into paying off the home mortgage. But yeah, the rates are going up. For some people, some clients, we've actually chosen to break their mortgages earlier because we couldn't, their cash situation couldn't tolerate a higher interest rate in 12 months' time. So we've wanted to take the hit on that and get ahead. It just comes down to your particular situation, what is the appropriate strategy for that.
Lots of questions on retirement. So I should point out that we do have a specific retirement and wealth webinar coming up later in the month, but we'll answer a few of these because you're on the line now, Mike would like to know, if I want to retire at 65 years old, how much money should I have in my superannuation?
Yeah, it's such a common question, isn't it? What do I need for retirement, and where should that money be sitting? So what you need for retirement, if we think of the rules, not the rules, the logic, you need to be able to fund your expenses for 25 years to 30 years without any employment or business income. So we need to understand, well, what are those expenses? What is your lifestyle cost? And then let's multiply that out for 25 years. We recognize that you're going to get the pension, so that's going to reduce what we need to have saved in a nest egg. I'm assuming that you're mortgage-free on your home. That's a key assumption. And I'm also assuming that you have financially independent kids, because if either of those two assumptions are wrong, then the strategy we need to adopt is materially different, which is why we always focus on trying to get you mortgage-free as quickly as possible, because it lowers your living costs when income stops. The rough rule of thumb is that you need about $1 million to fund your retirement and a mortgage-free home. Now that drops a little bit if you are single, but it also increases if you want to live slightly above average in retirement. A lot of people think that the retirement costs, that when you move into retirement, that your expenses drop. But in our experience, it's the exact opposite. The first 10 years of retirement is when you want to enjoy it, and any potential savings you could have made, you are choosing to spend on bucket list items while you're fit and healthy and can enjoy it. Once you've finished your highly active years, then your retirement does start to cost less, but not to the degree that you feel that it should. Normally there's about a 20% drop in living costs after that, and then maybe so if we think of the 10 years of retirement, the first 10 years we're not expecting any drop in living costs, where in some instances we're expecting those costs to increase. In the second 10 years of retirement, we'd expect your living costs to drop by about 20%, and in the third 10 years of retirement, we'd expect your living costs to drop again by 10%. So we have to understand those numbers to tell you exactly what the number is going to be for you. But very, very crassly, a mortgage-free home, $1 million in the bank. Most people have that money sitting in, normally about 40% of that is sitting in their superannuation, and the rest would be sitting in savings, ideally invested with an investment plan. We just need to make sure the numbers are right for you.
Couple of questions on KiwiSaver. Should I only be putting in the minimum required for my employer to match it? And how often should I be checking on my KiwiSaver?
Right. Yes, you should only be putting in the amount that your employer matches. Putting more in is not a bad thing. If anything, it's a compulsory form of saving, which is great. And you can't re-access it, which for the shoppers is perfect. But the problem with that is that you can't access that money to put it to work before you're 65. So the amount that your employer contributes into your KiwiSaver, yes, contributes to get that amount, because that is free money, and it's the equivalent of 100% return on your own investment, which is incredible. It also unlocks the government's random contribution as well. So you don't want to change that unless you have to. But if you contribute more than that, in most instances, we'd be able to get a better return with that money if we could channel that into paying the mortgage off faster, accessing the equity that mortgage-free or mortgage amount that's been repaid has created, and then buying another asset with that, using that as leverage. So it's not bad to contribute more than your employer, but if you want to grow wealth faster than what you're on track with your KiwiSaver, which most people need to, because KiwiSaver is only going to contribute to 40% of what you need, then we need a plan, and we need cash for that plan. So we'd be wanting to redirect that money out of what was your voluntary overpayment to KiwiSaver.
Nicola would like to know, do you advise paying a lump sum off when changing fixed term mortgages?
No. Yes and no. If you're going to make any lump sum payment on your mortgage, you really want to flow that through a revolving credit facility, which means that, yes, it's the effect of having paid off that mortgage, but you can re-access that money if you need to. You need that for two reasons. Firstly, to give you flexibility or to make sure you're financially resilient, because I don't know about you, but as soon as you will show initiative, generally you live to regret it quite quickly. So the best of intentions of paying off the mortgage, which is great, probably the next week you would need to re-access it, because that's just how life works. So we need to have the flex so that you could do that. But most importantly, we want to be able to re-access that equity and channel that towards a strategy to grow wealth if we needed to. And the problem is when you make a lump sum payment on your mortgage, which is a good thing kind of in concept, but you have you've shortchanged yourself because you haven't allowed the ability to maximize what that money could do for you in the future. You've basically given it to the bank, and now if you want to get that money back, you now need to go back to the bank and ask for it. And the problem with that is that the bank can say no. And that is annoying because it was your money to start with. So we just want to, you've got to be tactical when it comes to structuring your mortgages and trying to create wealth, because it is a purposeful journey. And we assume that the banks aren't always wanting to be helpful, because that's just how the economic cycle works. We assume that there will be good days and there will be bad days, but flexibility is key to everything.
Just before we take one final question, just a reminder that we have recorded this, and if you've had any audio issues, we're going to be emailing you tomorrow with a link so that you can watch it back or share it on. A question here, Hannah, from Jane. Jane O'Neill, now that the investment rules have changed regarding claiming interest on the repayments on an interest-only schedule, are you best to look at a principal and interest repayment schedule? We have 2 investment properties and are looking at a third.
No. The short answer to that is I would likely say no. I think that the question we first need to ask are the 2 existing properties that you've got now the right properties to continue to hold for the next cycle? And in answering that, we've got to understand the opportunities that attach themselves to that property and the opportunity cost. So it is now going to cost you more to hold those properties because of these new tax rules. Does that mean that could we have gotten that money and got a better return somewhere else? Possibly. There's probably a checklist of 12 things that we need to work through to make sure that it makes sense to sell a property. But I wouldn't, one of the last things I'd be considering is converting to principal and interest rather than assessing first whether it's the right property to hold. There's a little bit more to that, but I'll probably just keep it at that level to start with. With the new legislation that's been proposed, which we haven't even seen the final version of, there is some wording in it that actually says, and I think it's an unintended consequence that hopefully will be addressed in this final legislation, but it almost says that if you change the way that your mortgage is structured, you run the risk of not being able to claim any of the interest on the mortgage that you've restructured. Now, I don't think that that is an intended consequence, and I certainly don't think that it's intended for you to be penalised by paying off a mortgage for tax purposes, but the wording is vague enough for that to potentially be caught. So that's kind of your immediate halt until we've got clarity on this legislation. But even if the legislation gave us permission to do that without any negative impact, we need to first ask, always look back at your balance sheet. Are we holding the right assets for what we need to achieve in the next 10 years? Could we sell an asset and get a better performing property instead of just buying another property? Because you want to be active holders. You don't just want to hold and forget. Every year you're assessing, is this property the right one to continue to hold? There's a lot to that, but that's kind of the high level thinking. But thank you very much for those who have tuned in to listen. There are so many questions. I can see them all popping through. We've got a webinar series at the end of this month where I'm going to focus on more of the strategies to pay your mortgage off faster. On average, Enable Me clients are mortgage free in 8 years, as an example. So we will show you how you can do that. We're going to show you, if you are wanting to buy a property, what that looks like, so that you don't buy a lemon or an inadvertent citrus variety of property. We're going to talk about wealth, how you create an investment plan if you're not wanting to invest in property. For many, though, it's a blend of both of those things. And we're going to talk about how you get ready for retirement. So there's heaps to come. We hope you tune in for that. For those who want to come in for a consultation, there's a discount there if you want to take advantage. We'll send you a recording. Thank you for having us. Stay safe, everyone.